So today is our second lecture on how to finance sustainable real estate. A very quick recap. On Tuesday, we talk about asset level. We talk about building level, basically. Then we talk about both the equity side, the private equity introduced his private equity. That's last year's best team in Charles' class, final project, and also the mortgage side. That's the asset level. Today, we move on and we talk about this portfolio level. So basically, that's the structure. Then next session on this topic will be global level, this global sustainable real estate market. So still go back to our diagram, this big picture, as I always show. We have this sandwich structure. We have this individual and users in this physical space market to choose whether to live, work, play in green buildings and green cities. Then we also have these individual investors put money in pension funds and insurance companies, and then they become big investors to invest in sustainable real estate. And then we have equity and debt. So now, today, we are going to talk about these big guys. These small guys, last class, individuals and the private equity. Now we are here, REITs and the big companies. That's on the equity side. And then the mortgage-backed securities like and the green bonds. So that's for today, they're both on this public market. So basically, we will talk about first still equity level. That's basically REITs. And then debt will be green bond. So that's basically the vehicles. Some investment vehicles on public market that target at sustainable real estate. Then we talk about the benchmarking and disclosure, some like basic tools and what's going on, all the data. So that's the 2 times 2 matrix of this. Then we are here. So basically, I'm not sure whether you are familiar with the concept of REITs. Who don't know what REITs is? Could you raise a hand? So everyone knows. So I think that's already being taught in the finance and the other classes. So basically, REITs is real estate investment trust. So that's a kind of a special stock. It's a company. This is a real estate investment trust. It's a company. It's a publicly traded, listed company on stock market. So they are mainly investment in real estate. So that's called REITs. And REITs, since REITs is a company and mainly equity REITs. And then they are here, public, traded every day. So one example is Boston Properties. So yes, so that's basically here. And we have 250 REITs right now in the United States. So they are big companies. And since they are the company, they can do all kinds of things. That's why they can do, so this is REITs, they are the public company traded. And then they can do their equity investment. So they reinvest their money or they raise new capital by issuing new stocks, right? So that's basically their equity money and invest in. And as a company, they can also go to the bank, because it's a company, we can go to the bank to borrow a loan from the bank. So that's they can go to the bank. And then they can also issue corporate bonds. So basically, although this REITs itself is here, but it can do so many things. Because this is a company, they can go to the bank, they can issue their own bonds, they can issue their new stocks. So that's a REITs. That's why we focus on this. Then you can understand the important role of REITs here. For those who forgot what REITs is about or haven't touched on this topic, that's a very quick basics of REITs. So REITs basically is here. It's a company, and then this company's main business, the core business to invest on not other factories or manufacturing or IT or biotech, no. they invest in income-generating real estate properties. So that's office, commercial real estate. Commercial real estate. So they invest in commercial real estate, and then because they are publicly traded, so actually there's so many investors. Maybe you are one of these, and I'm also one of these. All these investors, we buy the stocks of the REITs. So we buy stocks of REITs. REITs have our own money, and then invest in all the real estate. Then real estate, because they are income producing, they're commercial properties. Then they every year, every month, they have rents that become the revenue, and then you distribute. So that's basically the idea. The key thing is REITs, they enjoy some tax benefit in the United States, right? So then basically there's no corporate tax, income tax, but just the personal individual income tax. So basically the cash flow from those properties to this company this can pass through directly to individuals. When we get our dividend and all the things, we as an individual we pay tax, but pay income tax, but this level they don't pay. So that this is an advantage of REITs. Since you have this advantage, then there's also a rule. You cannot be so has this advantage, but then you need to also follow this rule is 75% of the income generated by real estate, and they also must invest all their asset mainly in real estate, 75%. You can invest a little bit more on other things, but the majority, 75%, need to be in real estate. And another thing is you need to distribute, because all the people are here, all our investors are here, so you are obliged to distribute 90% of your income. So all the income from here, you cannot just stay here to do other things. Instead, 90% of the annual income need to be distributed. So that's if you follow this 90% and 75% rule, so you can enjoy this tax benefit that at this level, no income tax, at this level, income tax. So that's the basic idea of REITs. So then, of course, as a company, they become a publicly listed company, they invest in real estate. Then we say, okay, then let's compare a little bit of this, for me, you as an investor, we directly go to buy a real estate, a commercial real estate, or I buy the stock of the REITs, and the REITs will go to invest in this real estate. So that's a direct real estate investing, right? To buy a building or buy a property, or you buy stocks from the REITs, a company, Boston Properties. And then they will use your money, pool all the money of the individuals together to buy real estate and invest in real estate. So there's two ways, direct way or indirect way from individual perspective. And someone can tell me these basics of the comparison, advantage or disadvantage of each one. Direct.
REITs allow you to have greater geographic diversification versus buying direct real estate, perhaps.
Why? But why? Why you can have this geographic diversification?
Well, because the REITs are larger scale. So, like, for example, a REIT could own properties in every geography in the United States. So you're able to sort of diversify away some of the idiosyncratic risk that comes along with an individual city or municipality.
Yeah. I think the basic rationale logic is, as individuals, we don't have so much money for ourselves. It's very hard for common people like us to invest. You have so many countries to go there to buy buildings. Then since REITs are stocks, they are small pieces, then you can buy different stocks.
So REITs were conceived as pre-tax vehicles, so that's their most important characteristic. So if you invested in direct real estate instead of a REIT, you will be taxed, for example, on your corporation level and then on your income level, and the REIT, whatever income comes out of the REIT is tax exempt in a way, and you're only taxed on the income you had of it.
Yes.
So I think that's the main advantage of investing of REITs.
Yes.
Direct real estate.
Tax advantage, please.
I think it's also that in case of REITs, it's not a shared, like it's a shared loss or a shared risk because like so many people are investing together as opposed to like buying a direct property, you're alone, like sharing the risk.
You want this feeling of together?
Yeah.
You mean here in the United States, or you mentioned India, or
Yeah, it's
also in India?
yeah, mutual funds, something like that.
Okay, please, and then you.
Already, you don't need that big amount of capitals to invest in. You can invest by a small amount compared to the direct investment that you need to have that large capital to limit the
Yeah.
barrier.
You don't have enough money. Not everyone can directly invest in real estate.
Investment is also more liquid.
Liquid, yes. You can buy and sell. Today you buy, tomorrow you sell. But building, you know, a broker, and it takes so long. So given this so good benefit and advantages, in this classroom, who have invested in REITs, please raise your hand. In your own money, I invested. Okay, not so many. Since it's so good, you should consider. But I only bought a little bit of REITs. So as we already covered all this, basically REITs are stock, right? They are stocks. So they are highly liquid. You can buy today, sell tomorrow, and you even don't need to know what are the real properties underlying, right? So you don't know. Maybe they just put money to invest in global, all kinds of cities, countries, and you don't need to go to there to see these buildings. And very transparent because the stock market and all these advantages, especially for our small investors, we really cannot do this first one. And so, but then another thing is you have lower control, but you need to make the trade-off, right? Because if you really want to control, it's a control freak, then you really want to do private equity. You really want to hands-on to change a property, or you really want to invest. For this, you just invest so indirectly, you even don't know what are the buildings behind. So that's basically the idea. As we said, REITs, basically the US is the birthplace of the modern REITs. But other countries and regions also followed and adopted the REITs approach. There's so many countries now have REITs because it's a very good way to make very, very illiquid real estate asset become a liquid thing that common people can invest in. So this is a very innovative, innovation of the financial investment vehicle. Anyone to tell me some story of the REITs in your countries? So the US, we know, we all know, and we invest in, but other countries? Just now you already talked to India. Do you want to see more? When India started the REITs?
I don't know much about it. For me, it looks like a concept like
Okay. And other stories? Please.
So in Colombia, we have an adapted figure of a REIT. It's called the PEY. It was founded in it's not on the board.
Okay.
It was founded in 2008 by a former colleague of Zhengzhen. So what he did was basically adapt the REIT model, the American REIT model, to adapt to our tax laws. And it works basically the same. It's a pre-tax vehicle. It's open. It's priced in the BVC, which is the Bolsa de Valores Colombiana. It's the Wall Street of Colombia. It's really small, so it's.
That was the first one, first REITs. The first one.
There's only 3 REITs. In
Three
Colombia.
REITs. Okay.
And that's the biggest one.
Oh.
We have 120 million square feet under management, and because our market is so small, it's not like in the States that you have REITs for each type of assets. You have a office REIT like BXP. You have
Industrial, like a Prologis.
You have different kind of REITs. They have from hospitality to retail to multifamily.
Okay.
Every type of asset. It's rather people still are not very educated, so they don't really understand.
You should go back to do this REITs. Julio, your story.
Yeah, in Mexico, REIT started in 2011, if I'm not mistaken. And I think what's interesting is 2010, there it is. Since then, the commercial property prices have increased significantly till before the pandemic.
What are other stories? later we will talk about China. Other besides China, South Korea.
South Korea. That was I believe that was more
Infrastructure.
Macquarie, I believe that was a Macquarie fund.
Okay.
But it does, the control issue does become an issue because, you know, the valuations for REITs are maybe lower than market, and people try to, you know, there have been attempts to take over.
Okay, good. So yes, I can talk a little bit more about China's REITs, and Qianan is the expert, right? So I want to tell a joke or a small story, not a real story. So basically 20 years ago, more than 20 years ago, when I was a graduate student, and my husband also a graduate, we were classmates in the graduate school, and we were together in a kind of real estate center doing some research with our professors. We share one professor. That's why we got to know each other. And then he was a master's student. I was a PhD student. So then the professor said, you, please do your thesis, master thesis on REITs. At that time, there was no REITs at all in China, but there was a lot of discussions because they understood this is so good and they really want to do REITs. Then my professor asked my boyfriend at that time to do master thesis on REITs and to evaluate, to forecast when is a good timing for China to launch REITs. That was 2002. And then he did some research and kind of analysis. And then he came up with a conclusion, it's not ready. In the next 20 years, no REITs for China, no need to do REITs, because there are other huge capital source and no incentive and very difficult legal things like that. He wrote a thesis to elaborate on why no REITs and to compare China and the US systems and then. So that was his master thesis about to prove that it's no need for China to have REITs in the next 10 or 20 years. That became the reality. Although it's a lot of discussion, if you search, it's a lot of discussion back to early 2000, a lot of discussion about China's REITs, but it's just a dream and nobody really launched and the government didn't launch. Until the recent recession, the recent pandemic recession, that at that time, the Chinese government really had the real incentive, not the tax advantage. It's not about taxing, it's just because they didn't have enough fund. Especially all the cities, they were losing a lot of money from land sale and all the things. At first, the cities were very rich. They had enough money to build infrastructure, highway, on high-speed rail, and all the things. And then suddenly they lost a lot of money because of the COVID and all the other things, and they couldn't sell the land. The real estate market was declining. Then they said, okay, REITs, good. REITs is a very good solution for the cities. And then they launched the very different animal. It's not like what we mentioned here in the United States model. Our is like this model, right? And the tax advantage is very important, and how the disadvantage advantage. They said, okay, REITs, good. They will use this concept, but they only apply to infrastructure field, infrastructure area. The transportation and the sewage and all the things, infrastructure, say, okay, now you're poor, right? No problem. You use REITs to get money from individual people, all the citizens. So that's a REITs. Then they extract the money from common people, become a REITs, and then they have another alternative way to gather money, and then they invest in real estate, not real estate, infrastructure. So that's China's REITs. I don't think they have this tax advantage at all, no. And just another way for the city and the city governments, especially city and provincial governments, to extract money from common people. And after this, now I think it's 2 years old. It's a 2 years old new baby. Recently, I got this information from the news that they plan to, but these 2 years were so successful. They have several like very huge infrastructure REITs, so successful that they were considering to expand the REITs to commercial real estate using retail as the first step. like malls and the department stores. That's all. At first, cities became so poor, they wanted to use REITs to save those cities, to give them another way to gather money for cities to invest. Now the real estate market was so bad, they wanted to use this to stimulate the real estate market. So that's my understanding, and we can listen to Qianan. But first, your question.
So, are these publicly owned REITs? You're saying cities issued REITs to pay for their infrastructure, so this is an alternative to a bond?
That's a very good question. I think the cities, not the city government, not the mayor himself, but they establish a quasi-company corporation. Then they made that a listed company with the main business of infrastructure investment. Then they use that as a special vehicle to issue REITs, not the government itself.
It's interesting that you shared that. It actually is the same situation happened in Thailand. So the REIT concept was like initially introduced after the Asian financial crisis to Thailand to help provide liquidity to distressed property at that
to save that market.
Yeah. So before then, in the 90s, we only have property fund for that pool all the real estate asset together. But nowadays we have it like, because of that event, we have it almost 20 years already.
Yeah. So always there was a trigger.
Yeah.
Otherwise, why bother themselves to create a new thing, right? This is a trigger. Now we have two experts for China's REITs, but be brave. You first, and then Marcos. Go ahead. Because Qianan came from Wanke, that's a very big real estate company in China. They established first REITs, right?
Yes. This problem because the China government financial prefer to the financial standard is more traditional. Because in China, with real estate and the finance
separated.
In China government, I think it's very dangerous. We can combine these two functions to mix. So also the public facility like the highway, like the logistic, like some prefer this to raise is more stable and safe.
Yeah.
But commercial like Wanda is not any real risk in China mainland. Also from Singapore and Hong Kong.
Yes. Okay, good. And Marcos?
Yeah, I want to add before the property rates in 2021, there are like the quasi rates within some companies like logistic levers. And so the public rates is about infrastructure and logistics. That's because the government wants to control the risk, the financial risk. They don't want some speculative trading for the commercial real estate market. But now since the situation changed, they do want
Yeah, they really want to rescue the real estate market there.
So they open to affordable housing at first, and then open to those kind of commercial malls and department stores. So that's a gradual change of the government's intention and motivation. But at the same time, the situation that is still at very beginning. So comparing the overall volume is very few.
Very small.
Yeah, the absolute volume is very small compared to the overall real estate market. And at the same time, the major investors are not common people. Major investors still like the private equity firms.
Okay, not us.
Like the pension funds. So the participation of the public is limited because it's a kind of information asymmetry because it's a relatively new thing to the public.
Very good. So that's why I'm thinking the following. This is beyond our class. I'm going to organize a conference in the summer, July 31st and August 1st, on Asia's real estate. So that will be an academic conference. We have papers. But I'm thinking to organize an industry event to talk about this REITs in emerging market, especially Asia. Because you can see these totally different animals. If you are interested, we can later discuss. I know you are interested. And if you are interested, we can talk together and how to organize because we have so many like new market for REITs. But this is not our focus of class. I need to quickly move on to green REITs. because we are talking about sustainability, right? So basically, even if you look back to our MSRD thesis, I think we have the database of the MSRD thesis. And in the past several decades, you will see, you can find some thesis on the REITs topic to evaluate this emerging market. So last year, a MSRD student, Chen Zhao, he worked with me and to interview institutional investors and also REITs and private equity to understand their preference and their perception of sustainable real estate, given that they are REITs, or given that there are some institutional investors behind the REITs, like big ones. They invest in REITs from the capital market, and what are they thinking about this ESG investment? So that's from his thesis. So basically, now, more than 60% of the REITs by the equity market, this big size, they are very ambitious carbon targets, so net zero carbon targets, and it's a very sharp increase, year by year increase. So now the ESG also very, very important for many, many REITs. They have their own net zero. When they talk about net zero, they mean their portfolio, all the properties they are investing. And then it's a huge increase. It's an impact of investors. But the very, very important thing is who are pushing them. Who are pushing them? So that's now we are doing, we wanted to do some research. Chen's thesis is kind of preparation of our in-depth understanding is like the following. REITs is here. We have 250 or 60 REITs. That's for the United States. And you will see that they're very, very aggressive. They are saying they're going to do all those net zero and the ESG. But why? Whether these managers of the REITs, they really from the heart want to do so, or they have the underlying institutional investors, they are pushing them. So these are the institutional investors like pension fund and those insurance companies and the asset management, BlackRock, all those. So then he went to interview those investors, this underlying behind the scene, the REITs. And the key thing is most of the institutional investors and behind the REITs, they are pushing. So these managers, they need to get capital. This is capital allocation. So if those investors said, I want to invest in you, I will give you capital if your portfolio have a higher share of the sustainable real estate, we will invest in you. So they need to get capital from them. So that's the fundamental driving force. And from our interviews from them, the key thing, the key patterns we found is that the leaders, these very, very, the most pro-ESG investors, I mean, those people, are from Europe and Western and Northern Europe. So I give you some examples of the Central Bank of Norway and also the Netherlands, Dutch pension fund. All those are very big guys, and they invest heavily in the US REITs. And they really pro-ESG. They say, if you do this, I will give you money, capital. And then among all our and Canadian pension fund, you can see all these Canadian real estate investment asset management, and the global in Sydney and Australia, Germany, all those, they were the people behind this. And then for the Middle East, very, very big guys, the investors, they care the least. I'm not sure, maybe we didn't really interview those who care a lot, but overall they care least, and the United States in the middle. I think maybe Asia also in the middle. So that's a basic pattern of this. So now the understanding is, this is a principal agent. This is the principal, they have capital in their hands. This agent, they get money and manage the properties. So maybe they are very aggressive, not because they really think that's important, but they need the capital. So that's our preliminary finding. But now we are going to do in-depth research. We have not started yet. Is to understand, we will have survey of those people. We will have more survey of those people to understand. So then I went back to literature. With any research, we need to look at what have been done. That's the literature. From the literature, we do see, for example, this paper, 2012 paper, they did observe that doing well by doing good, that also applies to green REITs, not just the green buildings. Remember, green buildings, we have this doing well by doing good. If you are green building, then you have a price or rent premium. But for REITs, similarly, but it's a portfolio level aggregate. Each REIT may own hundreds of buildings, aggregate together. So they measure the share of the green properties in that portfolio, the entire portfolio. And then you can see that for these REITs, their holdings, the portfolio, the share of LEED certified properties and the Energy Star also rose very fast in recent years, right? And then they did say, from the data, they have all the, do REITs research relatively easy, right? Because you have all the data, because they're all stocks. You just all get all the data, annual report, all the things, very public information. So they got all the data of the REITs. And they found that for those greener REITs, in terms of the higher share of the green buildings in their portfolio, they have a higher return on equity and also higher return on asset. And then they also have better performance. Then, of course, you can argue, when we do rigorous research, remember I mentioned this apple-to-apple comparison. Before the spring break, we also tested you on in the midterm of the apple-to-apple. That's we need to be very careful of the endogeneity. So then this kind of argument really may have this problem is the reverse causality. For example, better perform the REITs. They are doing very well. They have a lot of money. They make a lot of money. They have better performance. So they are more cash rich. So if they are more cash rich, then they can spend more on green investment. If you struggle with your performance, you need to first keep your bottom line, right? You don't have time or you don't have the resource to think about these ESG things. But the richer REITs, they are thinking about their image, they are thinking about their social image and cooperation, sustainability, social responsibility, so they invest. So that's the reverse causality, Bill.
Another concern I would have is that this is over 10 years old, and so now as LEED becomes more and more common in the market, I'd be interested to see like this study more updated.
Yes.
See the results for the same amount.
Yes, that's very good. Maybe another thesis can be done to update this, because this is not that difficult to do. So there's so many channels. So then they use the very advanced econometrics to address that potential other channels that they really pin down in their data set. If your portfolio of all the properties, an increase of 1% of the LEED buildings in your portfolio, you have this ROA increase by 3.5 percentage points, and ROE increased by 8 percentage points. And you also have a lower beta, means your portfolio is have a lower risk. So that's really was supported by the building level analysis. The building level analysis said that when there was recession like that, ups and downs, those more energy efficient buildings, they perform relatively better. So that's why if you have a portfolio of those greener assets, you can hedge the up and downs of the recession much better. So that's why, okay, this is old research. We want to update this. So that's why we are doing this. So now I have two related REITs projects. One is this, the other is this. So now we are doing something like that. From the news, we saw all this pledge to net zero, that. Cities and the states and also companies and all the REITs. So all the REITs they have. So I went to, in the spring break, I went to San Francisco, I went to Prologis. They are very, very progressive on this. They are logistics and supply chain. And we know BXP is very, very progressive. and we have other like data center REITs and all the REITs. So we collect data of all the REITs. We have a long time span, 2010 to 2019. And then with all the information, some are missing values, altogether we have now currently in our database 178 REITs in our data set. Then we want to understand not just like in this way to count how many green properties, right? That's one way. And then now we are gonna do two things: green talking and green doing. Maybe they are different, right? So because we observe so much talking, a lot of talking, and the news release and the conference and like that. And then green talking is one indicator because the investors, as us, we don't know really where are the properties, what's going on. We just read the news. So we are going to construct a green talking index by extracting their news conference or some senior C-suite leaders' media report or their annual report, say how ambitious they are. Then we create a green talking index. And then we measure their green doing, whether they really invest in real green things or just a cheap talk. So then we have green talking, we have green doing, then we see how they really affect the performance on stock market. Thus we have beta, alpha, and the return on asset, return on equity, all the outcome variables. So that's our research. So we are now in this stage of construct this green talking and green doing indexes. But we have our hypothesis. So we think, for example, this is the stock price. This is the time. Then suddenly there's a green pledge, net zero 2040. Then the stock market might respond because it's information shock. That's maybe like going up if the investors, they really appreciate that. If we don't care, then maybe there's no response. But if the investors, the individuals, they care, maybe we'll see this as an information shock. But whether it can sustain or they will go back, then of course, if you just talking, then after some time, the investor noticed and realized that there's no real action, so may go back. But for the green doing, for those rates, may continue to increase if will be sustained if the market really appreciates this ESG investment. So that's our hypothesis number one. Maybe it's the opposite direction because you talk about all those, whether what's these two relationship. You have your core business. You cannot every day do ESG, right? If this may be costly, and if there's no synergy as a substitution between these two things, you spend more money on ESG, you have less resource on other things, maybe that will go down. We don't know. That's an open question. So that's give you a sense of what we are now doing on this. And then let's move on to green bond. So green bond is a debt side. Equity side is a risk, right? The debt. So green bonds is quite easy to understand. So if you understand bond, what's the definition of bond? Bond basically fixed income investment vehicle, right? Equity is not fixed, variable. Bonds fixed. And who can issue? Government can issue. Just now we talked about this treasury bond issued by federal government here in the United States. And here cities municipal bonds, they can also issue. So there's government, cities and the federal government and all this can issue. And the big companies, they can also issue green bonds. So there's not just government bonds, but also this cooperative bonds. So that's the concept of basic concept of bonds. So bond is fixed income. So when we issue, it's kind of a paper saying if you buy this and each month, if you just lend money to us, to the government or to the company, then each month you have an interest rate, and then you would just they will pay back. So you have a very secured income flow as determined, as specified in this contract of the bond. So that's bond. So they have different purposes. For example, municipal bond, the city is here, my understanding, the city is here. they issue municipal bonds because they really need money to build city infrastructure and school and all this public service. So they issue bonds, municipal bonds. And then they issue municipal bonds, and then you need to pay back, right? You can issue bonds, then you collect money, a lot of money, then you build roads and all the infrastructure, schools, hospitals in your city, and then you need to pay back. The mean revenue that the cities can pay back can be the new mean money coming in can pay back the property tax. Because you maintain your city public service, your housing price can be very stable and even increase, then you collect in property tax, which is a flow. Every year you collect. Then use your property tax to pay back. The basic logic behind is you borrow money, upfront money, because you need to first invest. And then your city become beautiful and better service, then your housing price will be good. And then you collect property tax every year to pay back. So that's the idea. But as far as I know, in many developing countries, the cities, they are not allowed to issue bonds. And especially when the institution is not that very well developed, then you have no property tax. If the city does not have a stable income flow stream, how can you issue bonds? You issue bonds, then you have no money to pay back. So you don't have any credibility, and you don't have guarantee for the future cash flow to pay back. So I think that's a very big problem. From my understanding, my research in Chinese cities, they don't have property tax till now today. They only have very little tiny pilot, it's not real property tax. If you don't have property tax, then, but they still need money. The cities, they really need money to build. And then they have a quasi-municipal bond, then the city cannot issue because the city has no income inflow for future. They establish a special vehicle. A special vehicle is a quasi-company, like a state-owned infrastructure investment company, and they issue bonds. They really issue bonds because they need money. They issue bonds, and then they don't have property tax, but they sell the land. The government sells the land. And then they use the land sale revenue to pay back the bond. So basically, this is a government, city government, they cannot issue. This is a government, city government-backed company, they issue. They issue bonds then to all the citizens. Then money come in, then they transfer the money, not even don't transfer, just build infrastructure, and then there's no property tax. And the land, the government sells the land sale, then the money get money to pay back. But this is very dangerous and very risky, right? When you can sell the land, you can pay back. When you run out of the land sale revenue, then you are in trouble. You are in trouble because you cannot sell because the market is so bad, you cannot sell. All this, the city is shrinking. Shrinking cities. How you can sell the land? No money. And then they say, okay, especially in the recession, no money. And then the government all are crying, oh, no money, how can we maintain? Even without building new, how can we maintain? Then the central government said, okay, we will give you another thing, it's REITs. So I link to my REIT story of China, because they have no money and they no land sale, but they already issued bonds and they cannot pay back. Then they create a new thing of REITs. I talk too much about China because...
You cannot buy REITs, the Chinese REITs then?
No, you can still buy.
But
if
no good, not a good investment.
Oh, we are so optimistic about China's economic recovery, right? So if you are interested, come to my China class this afternoon. But we will stop here. But the key thing is REITs. No, the key thing is bonds. And then we want to understand bonds, green bonds. We are not talking about general bonds. We are talking about green bonds. So now it's a new huge trend from the data you can see from 2017 to 2025. It's a fast, sharp increase of the green bonds. What does green bonds mean? Green bonds are either governments or companies. They issue bonds, and they said when they issue, they announce or they say that we issue bonds, we collect money we are going to use on green investment. So that's a very simple concept to say, oh, we issue bonds. If you buy bonds, I can collect money. Then I will use on renewable energy, on wind farm, on solar farm, on climate resilience investment in the coastal areas, in the clean energy of the electricity, something like that. So that's the idea. On this, both government, if the city want to build, then they issue. If the company want to do green building investments, they can issue. So they say that. Question, Annie?
What makes a green bond green? Is it only the project that it's going to be funding, or are there special tax benefits to doing it this way? Like, are they tax exempt at the municipal level or?
No. I don't think they have tax advantage. But if they invest in those things, they have the incentive. For example, the Biden's Inflation Reduction Bill Act, right? If they invest in solar and in electric vehicles, they get this benefit.
Right, but the investor's not seeing any added benefit.
Yeah, but they may have an actual premium return from this.
Is it based on performance? Like, is it kind of retrospectively analyzed, or is it just you make the promise and then you get the funds?
You make the promise, because that's for the future. But it's not like a very cheap talking. Later you will see they have some way to validate. So yes, so basically that's a huge, and remember, REITs can also issue bonds, because REITs are also companies, right? REITs can borrow money from the bank, REITs can issue bonds, REITs can issue new stocks to raise fund.
Like US and other countries issue a bond also use that model?
Now, which model?
By the government and
Yes. This is a general concept of bond. So government and people must have trust in those entities that they will pay you back. Then you can issue bonds. For example, I cannot issue bonds. And how can I issue? Nobody will think I can pay back, right? So the REITs, they are issuing a lot of green bonds. So for example, we always use Boston Properties because they are coming. Zhengzhen will have a case study of Boston Properties, and they are coming here. And they are across the river, so you can see. And we are now trying to arrange our final presentation in the Prudential Center building to give you a business environment to really pitch. So green bonds, right? They issued several rounds of the green bonds. For those companies, what's the incentive for this? What's the incentive for them to make the promise and issue green bonds?
It's
cheaper. The cost of capital will be cheaper. Why will it be cheaper?
I mean, if you go back a slide, they're priced at like 0.5% above the treasury. It's really cheap money.
Yes, so they just need to pay very low interest rate to these investors. Yes, so basically, that's true. For example, this is research already done. 2019 paper, and this 2019 paper, they look at the asset level and also the portfolio level and show that the greenness of the risk, for example, they say, we are going to use this money to invest in green assets, green buildings, green infrastructure. They can really lower the bond spread, the cost of capital of the bond. They just get cheap capital. So they show this. So that's very clear. But this is on average. Remember, all the statistics about on average. It's not say if you tomorrow issue, then you will definitely get. So that's a risk example that they issue bonds, and then they have a lower cost of capital, lower spread. And this Fannie Mae also issue green bonds. So this is a government sponsored enterprise, right? So then, because Fannie Mae, they just purchase a lot of mortgages, right, from the small banks. They purchase this mortgage from the small bank, they securitize them, and they sell to the public market. And in all the mortgages, there are some green building mortgages. The energy efficient buildings, the LEED certified buildings, and this. And then Fannie Mae buy a lot of loans from banks. The banks lend money to the individual households and the buildings. And if those buildings, they are green buildings, they can identify in the pool of all the mortgages which are green mortgages, which are not green mortgages. If your pool has a lot of green mortgages, then the Fannie Mae said, this pool is a green mortgage pool. Based on this pool, I'm going to issue green bonds. Right, got green bonds, and then for the mortgage, the underlying green mortgage, the monthly payment to the bank pass through to Fannie Mae will pay back the investors of the bonds.
What's the percentage of the green projects or assets has to be in there in order to issue a green bond?
That's a good question. I don't know. We need to check. I think they have different types of the green bonds than Fannie Mae and Freddie Mac. They must have a very specific thing that now we can see that they have these ESG bonds. Green bonds is one of the ESG bonds. Then they have this environmental criterion and the social and economic. For example, you need to really reduce energy by 30% and 15% like that. So then you are a green mortgage. You define that as a green mortgage. But how much the share of the green mortgage in the pool, then you can see this green bond. I think that's a practical question. We can check. But you cannot just say, you cannot just announce. Carlos.
Question. Have you seen, except of big financial institutions like REITs or Fannie Mae, Freddie Mac, et cetera, committing like real estate development companies funding themselves through this type of financing, like green bonds?
Yes, yes. Now this all become more and more important. Those REITs, they issue green bonds, and because they saw the benefit of that, the lower capital, cost of capital.
Yes, but have you seen the real estate developers, like not huge, not
No,
related companies?
I didn't say that. Maybe later we can have Charles talk about this real world. But I think developers is very hard. You need to own the properties, and you need to be a very big, stable company. Otherwise, who will buy?
I think I can contribute a little bit to this question.
Yes.
So the company I was working for is heavily involved into the tax credit affordable housing or historical
In the United States.
in the United States with local government.
Yeah.
And sometimes when there is a gap and the government does not have a direct grant to you, they do use something called tax exempt loan, which is issued by the government agency authority, who is like a non-profit group related to the government. And they issue bond on behalf of the government, and then your assets become
But is it green?
That's affordable. So that's a social, right? ESG, social.
I'm talking about green because that applies for the whole world, not just the United States. That's my actual deepened question. This can be exploited on a very macro level, not just US level.
My personal experience is that it's hard to market this to the construction lender or kind of the senior permanent financier. But you do get additional equity investors, and you may have a lower cost of equity, so you may not see it so much on the debt side of things. You might realize it on the equity side of things. I mean, the reason I think you see these spreads, it's either in a bond, you have a lower interest rate, so to speak, on the bond for one of two reasons. Either the bond is perceived as less risky, which maybe there's an argument for that, or there's a lot of capital chasing fewer of these types of assets. So if it has real green credentials, there's a lot of people who want to buy that, which just drives down the cost of capital. That's what I experience in the real estate market from an equity side. But when you're dealing with smaller lending institutions, the debt is priced
Very expensive, right?
well these days.
Small
it's
ones.
horrible.
Yes. So I just want to clarify one thing. I think that's a basic concept of bond. It's no matter which green bond or general bond, you have a contract, like a paper. When this is a bond, they say this is $100, and then each year we promise to pay you back because it's fixed. Right? Each year you have some cash flow you will receive a check of this Well, this is book value of this. Then each year you will get $2. And then this is on the paper, but then later this bond will be traded on the market, right? If this is very popular, someone will be willing to pay $110 to buy this paper. So this paper is a contract to say future cash flow will be calculated based on the book value times this interest rate. Each year you will get $2. But those individual investors, based on whether it's popular or not, will be willing to pay higher price to buy this, or it's not popular, will pay lower price. Will be, say, $90 or $110. So that will totally be market because it's a public market. So suppose this is a green building, green bond, and it's very popular, and we see this $100, but investors are willing to pay of us, willing to pay $110, right? Then that's so good for the issuer because you can still pay this little, but you get more money. That's why this is a cheap capital. That's the idea. It's not like always fixed at this price, but this transaction price will vary according to the market condition. This is just on the paper, this bond fixed income. So that's help us understand. For example, when Boston Properties, they issue this, they have these papers, but later how this will be valued in the market, that cannot be controlled by them. That will be controlled whether these are popular and whether the investors are willing to pay to buy those papers. So then that's why you cannot just talk. You cannot just say, oh, I promise you when I collect the money, I will do this and do that. It's so good and so solar panel and all the carbon reduction things. You need to stick to, this is a climate transition finance handbook, and they have these green bond principles. I don't think this is a law. This is not from government. This is kind of nonprofit organization. But they kind of association of all these green bond issuers, they say, let's stick to this. Then if you see your green bond, you must follow all those principles like this and that and all the details. So then you can see your green bond. It's kind of certificate of the bond. You need to meet this, you have green bond. You cannot just argue. You cannot just greenwashing. Okay, so then I'm gonna, that's give you a basic, very basic flavor of the institution portfolio level, how to raise money from the public market to finance sustainable real estate. Equity, we talk about REITs, and then we have this debt, we are talking about the green bonds. Now I'm gonna do something about this final thing, and then I will pass on to Charles about final project. Now today we need to assign the final project, then you will have something to do. So, but before that, I'm gonna talk about this. And as you know that all the things are measurement. If you have no data, if you have no measurement, and then if you have no benchmarking, then that's cheap talking. We just say, oh, green bond, green REITs, we are so green. So what? And who will trust you? Because of then your value will depreciate. Maybe just a 1 day information shock, then you will depreciate. So that means data and measurement and benchmarking are so important to build the credibility of this green, how green you are. Then now there's an emerging field. Maybe later you can find jobs in this area because there's a huge need for this data and transparency, information to solve this information asymmetry problem. So there's many companies are doing so. Many of them, they are startups. This data analytics and this kind of companies, but then they become big. So for example, and some are government provided. These are all examples, and also from Chen's MSRED thesis. He did a very good summary of this. Data acquisition, so there's some software called Portfolio Manager provided by the EPA, that's a government thing. Then this is very fundamentally to collect all the utilities data from each building. From each building, they use this. Because then they can share. You need to have a standard format and the software to collect all the information. So for example, now we are working with a REIT called Varus. Varus is a residential REITs, multifamily REITs. So we are now collecting data from Varus, and we are working with Christoph Reinhardt, the professor in architecture to do energy modeling for those multifamily risk properties. Then they said, we want data. Then they said, you sign up for this, and we will transfer the data from this portfolio manager to you. Then we create an account, then they transfer data. So we have the data because we share this software. Then you need to integrate the data and visualize the data. So something, it's a Marable. Now it's very big. At first, maybe a startup. Now it's a very good company. They are doing all this ESG and carbon accounting data, and how to aggregate from different utility sources and their buildings and the different types. So that's Marable. And you cannot just do so. You need a third-party assurance. It's very similar to accounting, right? Accounting is about money, financial. Now you need carbon. Not accounting, audit. You need a carbon audit, third-party assurance. This DNV is a very not popular one to issue an assurance opinion. It's just an audit of whether you just make up numbers or these real numbers you cross-validate, and that's the audit of your carbon. And then you calculate. As we all know, scope 1, 2, 3, you need to report, especially if you are a listed company, you report. Scope 1, scope 2, scope 3, then they have those companies, those data analytics companies. They have algorithms that you just pull the data into this, then they calculate for you 1, 2, 3, like that. Of course, scope 3 is the most challenging one. 1 or 2, relatively, you just formulas and all the parameters you calculate. Scope 3 as embodied carbon is very difficult. So I think their challenge is who can calculate the most reliable scope 3 embodied carbon. Then you evaluate and benchmark. Say, oh, this company is so much, this company is so much, right? Numbers got audited, reliable, calculated. Then you need to evaluate. When your portfolio will become a strength portfolio, means under this regulation thing, then you lose value. That's a model of the cream. Then you let you know your portfolio is in danger, it's in the risk of later exceed this carbon cap. Or you benchmark with your peers, that's a GRESB. So I will just quickly go through GRESB. Very interestingly, I told you that my day started at 6:30 this morning. I went swimming again, and then I had a lunch with GRESB. GRESB is a company called Global Real Estate Sustainability Benchmark. You can think about this. I think they already talked about this in the first session, right? GRESB. So this is a portfolio version of LEED. Think about that. LEED is a building level certificate. LEED, silver, LEED, gold, LEED, practicum, then you know it's a certificate. Rating system, that's on the building level. This building is LEED building, that building is not LEED building. But when you go to portfolio, like a REITs, like a big asset management company, they own, like a pension fund, they own hundreds of buildings in different cities, different countries, different types. Maybe not just only buildings, but also other real assets, like infrastructure, this and that. Then they also need a measure, a benchmarking tool as a certificate to show how green your portfolio is. So that's a GRESB. So GRESB, the founder of GRESB is a professor, Niels Koch. He founded this GRESB as a startup. Then he sold to become so big, and he has no time to manage. He needs to write papers like me. He sold, but he's very entrepreneur. And he's a professor in the Maastricht University, and he's a PhD supervisor of Juan, Palacios. So you know Niels Koch. I think he will always come. He will later come. But already he sold this company. This morning, this company, as you can see, headquarters in Amsterdam. And they started this. Now they have a US business. And the US business is a small office of few people. They just reach out to me, say, can we talk? They want to collaborate with us. Then I say, they want to talk today. Then I said, I had no time. I have so much teaching and all the things, no time. Then we said, okay, breakfast. Then after With me, I went to Flower, and with 3, we sat there for 1 hour before our class. I talked about GRESB. And they really wanted to work with us. They want to expand their US market, but they don't know how. They just data provider. They have a lot of it. They have more than 10 years of data of all the portfolio. They have portfolio, but they aggregate from buildings. They have building level, they have portfolio level, all the indicators. Then I talked about how we can do together. I say we are scholars, we do research, but we can translate our research how to be useful to you. And I talked about our collaboration with Moody's. Now we have another collaboration with Moody's on the climate and commercial real estate. I think we can later establish another collaboration with GRESB, and then we can have all their data, and then we can do whatever we want. Another thing, they really mentioned they want to hire interns. So if you are interested in interns, so their US office is just based in Boston. So they said they want interns. But first, you need to understand what they are doing so that you can say if you want to do internship in the Boston office. So as I said, it's a portfolio level lead. So they are measuring ESG, and they have, so basically it's a scores. They have the overall score, they have sub-scores of every aspect you can think about of ESG. You have the leadership, and because it's ESG, not just the green, right? There's the leadership and stakeholder engagement, and they also have energy, materials, and they have this social aspect. So basically, they have many subcategories. Whether this is very scientific, I'm not sure, but they are developing. They are developing this as a first step to have these subtopics, sub-scores. Then they have their weights. For if this already a very mature portfolio, that's management always have 30%, your company leadership, this governance, all the things, then you have the performance of your properties. And this one is like a development things, like if you are more like a all the development. So then you have this. So the key thing is they have a report. The companies, the portfolio company, the portfolios, for example, those REITs, they need to sign up for this. For example, this is voluntary because they are not a government, right? They are not government say you must report data to me. No, they are, at first they were a startup, now it's just a very popular rating company. Then they say, okay, if you want me to evaluate your portfolio and give you a score, you sign up, you register. Then you give us all your data, submit all the data to GRESB. And then we will do all these ratings for you. So for example, this is a Cura REIT Corporation, that's an example. Then because this is many portfolios, they sign up, this asset management companies, pension funds, and the REITs, they sign up, then they have a lot of data because they collect all the data. Then you can compare with your groups, and you can make the trend this year, that year score will increase or not. And then you have this asset strengths and opportunities, which part you lag behind, which part you are the leader, and how to improve. So they will, So then you say, okay, this part waste, you need to improve. Water, you need to improve. And you are doing this data monitoring so well. So that's analysis. They will give you a report. This is give you an example because later we will have guests from Boston Properties. You can see they are doing very well in terms of the GRESB. They say, okay, 90 out of 100, their score is 90. And the peer average is 79. So good, better than the average. Then each year you will see the trend. Basically, and this data, after they gather data from all the companies, they won't put them online. So this is, for example, for me as a professor, I want to do research, use GRESB. I need to buy data from them. That's why this morning I was happy because they are coming to me and try to collaborate. So I say, first step, give data to me. Then I can get free data from them, which is good. Now there are 1, 2, 3 papers already published by other scholars. They got data from GRESB. And they started how you cannot just have the rating, but you need to show whether for the portfolios with higher GRESB rating score, whether that will lead to better real estate return to justify why you want to go green, right? Why you want to have ESG. If you do ESG, then your stock market, stock performance goes down. That doesn't make sense. So this paper, this very new paper, private equity. Private equity, they collect all the private equity with GRESB scores, and they run regression. They show that really GRESB participation and performance are both significant of the fund, private equity. This is private equity fund returns. And then this paper is about REITs. Similarly, they started ROA, ROE, and all these indicators. They also show for those REITs with higher ESG and higher GRESB score, they have higher performance. So that's the other paper. Finally, they also show that for those REITs, they have higher GRESB scores, they go to the bank, they can get cheap loans, lower the cost of capital. That's so good, right? You have better performance, you have lower cost of capital, then you make more money. So that's another paper. But this still on average, it's still statistics. It's not say this REITs you get higher GRESB score, then you will guarantee you get this lower cost of capital or higher return. But on average, these three papers showed if you have a higher GRESB score, you have lower interest rate when you go to the bank to borrow money, then you have better performance in terms of the risk or the private equity to justify the benefit of ESG, and also then GRESB will also become famous. Then all the companies want to get the GRESB score. So I'm going to skip this. And finally, I want to say one thing is I cannot only say good things. Another, on the other hand. Now, Professor Roberto Regenbaum at MIT Sloan, they have a team, a research project called ESG confusion. So confused. That's a ESG confusion, which means now there's so many ratings. GRESB is from the real estate sector. Then you have this and that. You have a lot of things like MSCI, Rep Risk, and S&P Global, and Moody's also have. There's so many ESG ratings. If you Google, so many, because it's such a good area to make money for these rating companies. They publish their own ratings, and their own ratings are not consistent. So, are not consistent at all. They are not correlated that much. So, it's very confused. Data are noisy and messy and unreliable. So they created this ESG confusion project to understand, you see, the correlation is so low, like 0.5 or something like that. This company says it's green, that company says it's not green. It's so confused. We even need to question whether they make up some data, or is it really real data or not, or what the methodology is about, whether it's greenwashing or not. So they are trying to develop a methodology, not trying, they already published papers. And they already published papers, they have a very innovative methodology to crack this information and to make sure how to derive a reliable ESG measure from these noisy measures. This is really away from econometrics thanks to this very advanced methodology. So now we are a small part of this ESG confusion project. We are looking at the real estate side.